Welcome to PhillipCapital Weekly Market Watch. I'm Lin Sin from Unit Trust Research. Today, we would like to share with you some investment ideas or our preferred themes for 2014, which could potentially present good investment opportunities for you. After the market wake-up call in June 2013, the US Federal Reserve has decided to take baby steps to unwind its unprecedented ultra-loose monetary policy in their last FOMC meeting in December. Notwithstanding that the US Fed reinforced its commitment to maintain a low interest rates environment, with a widespread speculation that the rates will be held low until at least the year of 2015. The European Central Bank and the Bank of Japan have pledged to maintain their loose monetary policies, which takes us to a divergence in monetary policies between the G3 economies. With US normalizing interest rates, where the global interest rates are set to rise in tandem, bonds lost favoritism. The year of 2013 has witnessed an exodus of funds from the bond funds as they lost grounds. With the brighter global prospects, investors are much more confident and are prepared to take on more risks, but also shifting their focus from hot markets back to quality ideology. Against this backdrop, here are some of our opinions for your consideration. First, North America. Through the infamous quantitative easing program, the US Fed has injected over $4 trillion liquidity into the world's largest economy to revive consumer spending and spur economic growth after the financial crisis of 2008. After 5 years, as of end of 2013, the US economy recovery is finally showing signs of gaining traction, while labor market is picking up a bit beneath inflation. Taking cues from the data, at its December meeting last year, the Fed decided to slow purchases, along with a new guidance that its benchmark interest rates are likely to stay low well after the unemployment rate declined below a threshold of 6.5%. Optimism was reiterated by the World Bank as well as the perceivably dovish icon Janet Yellen, who will succeed Ben Bernanke as the first female head of the Federal Reserve on February 1. The upbeat sentiment was translated in the major indices such as S&P 500 and Dow Jones Industrial Average. Wall Street closed 2013 at records, with the S&P 500 posting its largest annual jump in 16 years, and the Dow its biggest gain in 18 years. The Chicago Board Options Exchange Volatility Index, also known as VIX, a gauge of S&P 500 options, is trending lower, while most of the S&P 500 companies, which turned in their fourth quarter 2013 results, met or beat their operating and earnings estimates. Despite markets are anticipating for a correction ahead, based on the fact that S&P 500 has elapsed 27 months without slipping into a correction, and amid 2014 being a midterm election year. However, we do not foresee moves on US stocks falling into a new bear market crystallizing. With expectation on improving profit margin and a tailwind for earnings, we suggest investors to stay invested with quality companies for the long term. Number 2, Asia Pacific x Japan. Asia, with its resilient domestic demand and strengthened fundamentals following the Asian financial crisis of 1997 to 98, has weathered exogenous and internal economic shocks, and even led the global recovery in recent years. Outlook for the region seems to have stabilized after the news on inevitable QE tapering, which brought disruption to the markets in the second half of 2013. As global growth gained momentum, Asia's exports and growth are poised to pick up. The broadening out of G2 economic recovery will benefit the export-reliant economies, while favorable demographics and rising income will bode well with the long-term growth. Hailed as the growth powerhouse of Asia, China's full-year GDP growth in 2014 is expected to come in at 7.4%, as the $8.23 trillion economy decided to bite the bullet to rebalance towards a more sustainable growth model. Despite being the slowest pace since 1990, the Red Dragon of the East is envisaged to continue to outpace the developed economies this year. Notwithstanding that the markets will remain to be susceptible to to national policy developments, as well as Fed policy developments, China's broad-based reforms, and the massive international trade pact, also known as the Trans-Pacific Partnership Agreement, are likely to present plenty of opportunities for investors to ride the new growth wave. Number 3. Dividend yield equity funds. The income story continues into 2014 and remains as a major or core investment strategy for most investors. Following are some of the reasons on why you may wish to consider equity funds which offer sustainable income. Firstly, safe haven assets is losing their investment darling status as global growth picks up steam. International Monetary Fund (IMF) in early January 2014 revised its global economic growth outlook for the year upward by 0.1 percentage point to 3.7% from its last outlook in October 2013. This boosted investors' confidence and risk appetite. Secondly, with the Fed's decision to gradually close the liquidity tap, which has been depressing interest rates over the years, the great rotation out of bonds into stocks is starting to gear up under a rising interest rate environment. Last but not least, given the Fed's forward guidance on maintaining an accommodative monetary policy, and both ECB and BOJ to have their aggressive monetary easing campaign full steam ahead to juice up growth and inflation, long-term inflation expectation is well anchored. Compared to bonds, stocks with dividend-paying strategy may comprise higher risk, but it may also reap higher real investment return for investors. Dividend strategy offers regular income, which is wealth accumulation, as well as to hedge against inflation. Dividend payment may partially offset negative effects of inflation. It also offers opportunities for capital appreciation, that is, capital preservation to a certain extent. Investors may wish to consider dividend yield equity funds, which invest in companies with above average dividend yield, good corporate governance, sound fundamentals, consistent profitability, and earnings growth prospects. Tables are turned from a year back, when a lot uncertainties whether the developed economies will be able to prop growth and will there be a double-dip recession. Some may regret for not joining the equities rally last year, but as an old proverb says, the best time to plant a tree is 20 years ago. The second best time is now. That is all that we have for you today. Thank you.